Hello and welcome to this week's episode of Spy Trader Now. And let's give you that update right now. We had no trades during the week, so our portfolio did not move much. We're still at the up 21% year to date. We are still sitting 100% in cash. The S&P 500 SPY ETF did decline a small amount during the week, and its total year-to-date return is now at minus 19.38%, which you can see right here. So compared to the S&P 500, our strategy is completely smoking it by 40%. The S&P 500 is down 19%, and we are up 21% year-to-date. And we do a 3-position portfolio with our strategy. We have SPY stock, which is shares of the ETF S&P 500, or we'll do SPY options, either puts or calls, or we're in cash. Right now, you can see here that we have a cash position, $121,000. We start off the year at $100,000. So we always start the year off with $100,000. So we can we have some working capital to work with for investing, and then we determine where we're at during the year. And currently we're up 21%. Now, with our strategy, we buy, sell, and trade the S&P 500. We are not buy and hold investors. So that is why we are trying to put more of this green in your wallet. Here is a snippet of the stock chart for the, we're going to go through the charts in great detail, but here's a snippet of the, it's actually a 1-year chart of the S&P 500, kind of like where we're trading, where we're at right now. We'll go through this in greater detail throughout the presentation. We'll show you exactly. You can see on 12/9/2022, we sold and went all cash on this candle right here. Kind of 2 days late. I wish I'd have sold out right there, but didn't see that pop coming. All right, now we're looking at this from a weekly chart, and you can see that over a weekly chart, the S&P 500 only dropped 0.09%. Basically, it didn't move. This candle right here, this is the thumbnail of the chart. This is a 5-year chart. Weekly candlesticks. So each one of these candlesticks represents 1 week's worth of data. The one on the far right here and the one on the far right here is the previous week's trading action. This candlestick is what's referred to as a spinning top. That's when you have a long tail, a long wick, and a small body in the center of the candlestick. And that represents indecision and a change of direction. We did come from up here down to this spinning top, which gives you a representation that there's a probability that you're going to stop here and can advance now to the upside for a certain period of time. Now, the MACD, which is this right here, this portion of the chart, moving average convergence divergence at default settings. This oscillator, which is an indicator, it is telling you that the MACD has topped, it is wanting to come down, but it has not crossed the signal line. When the MACD black line is above the signal line, the red line, that is a positive condition for the stock market, meaning that when you cross, especially from a negative to a positive, that is a bullish time. You can see how we advanced here during that time frame. So that is a bullish time that you want to be in stocks. This tells you that that momentum has kind of dried up. We've started to come down on the histogram, but it hasn't quite softened enough yet to cross below the signal line. This here is the slow stochastics at default settings. It's another momentum indicator, and it has topped at just above 80 and has crossed below its signal line. The slow stochastics is telling you that the market is wanting to come down. You know what's interesting here is that it's how you always have these cross currents. You have one indicator telling you one thing, you have another indicator telling you another thing. You have candlesticks, and like reading the tea leaves, you're getting all of this information and you're trying to determine how to play the market is what you're doing, because we are not buy and hold investors. We are buy, sell, and trade investors. Okay, so that is what this particular chart is telling us. We don't know that, it's not confirmed. Even though this candlestick is telling you something, that doesn't mean with a 100% guarantee that it is going to stop here and now trade and travel upward. There's no guarantees with any of this. So you just do the best that you can and you try to trade from what the information is presented in front of you. We made no trades during the week. Our last trade here was closed out on 12/9/22, as you saw on that previous slide. Please go to my website, spytradernow.com. This is where you can sign up to get real-time trade alerts. So when I do make a trade, you can receive that trade through text message and email. You can also, I have links to my YouTube channel, which hopefully you're watching this video on YouTube right now. And please go ahead and hit that subscribe button, ring that bell to be notified when I post a new video, and please do me a solid and smash that like button down for me right now. By the way, if you go to spytradernow.com, this is just a snippet of my trades. You'll see all my trades going back for the past 3 years with this strategy. Now here is our portfolio. Now the information, I didn't start doing this till a few weeks ago, so this information isn't exactly accurate because the portfolio did not sit at $100,000 and then jump up to this figure here, which is about $118,000. I started tracking it here. So this information going back 5 weeks is about accurate. It is accurate, I should say. And then I'm going to continue to do this from now on. There's only one more trading week left in calendar year 2022. Starting in 2023, the portfolio will start at $100,000, and you will see how well I track in calendar year 2023. So I urge you to subscribe to my channel and watch, and we'll see how well this portfolio does in comparison to the S&P 500. The S&P 500, this is 100% accurate data. This is where the year started out. Price per share about $475, and this is how each week the S&P 500 has fared. So you can see over the past four weeks, it's softened up. Now this is a comparison between the two strategies, the pink being the SPY buy and hold and the blue being SPY Trader Now portfolio. And you can see that pretty much I've been in cash and the market has softened up during that time that I've been in cash. Now the Fed, here's Jerome Powell, head of the chair of the Federal Open Market Committee. The last decision for Fed rate hike was on December 15th, where the Fed raised it 50 basis points. And this is the level that we're at right now, 4.25 to 4.5. Forbes put out an article recently that states that into 2023, they have an expectation that the Fed is going to raise rates to a terminal rate of between 5 to 5.5%. Well, if we're at the upper end now of 4.5 and we're going to 5.5, that means we have one more percentage rate, 1% to raise. And the way that I'm looking at it is the last rate hike was 50 basis points. The Fed's going to push two more 50 basis rate hikes at 50 basis points to reach that 5.5 upper end target. And then they'll begin to slow down and see how well all of these rate advances, rate increases that they've done in calendar year 2022, how they're going to affect the economy. Bottom line is what the Fed needs and wants to see is he wants to see the unemployment rate go up. Because with the unemployment rate going up, that should have a clear indication that inflation rates are going to taper down, which is what the Fed is after. Here is the 2023 FOMC meetings calendar. So the next meeting is going to be January 31st, and they'll put out an announcement on February 1st. So we have about 6 weeks before the next Fed meeting decision on what they're going to do with interest rates, but it's very possible that they're going to do a 50 basis point rate hike here, and then in March 2021, March 21st, and then the announcement is on the 22nd, and when on that announcement, that will be associated with a summary of economic projections. I'm expecting another 50 basis point rate hike during that meeting right there. So we'll see how well this happens. But the Fed is really having the greatest. How the stock market really performs right now is based off of what the Fed is doing and what the Fed's interest rate hike cycles are going to be. We know what they've done. We have an expectation of what they're going to do, and how the stock market moves moving forward in 2023 will be largely dependent upon the Fed and this man right here, Jerome Powell, the chair of the Fed, to determine what happens in the stock market in 2023. Let's move on. Another indication that we track is the yield curve. So we get this information derived from bankrate.com, and you look at Treasury interest rates. We monitor the 91-day, which is the 3-month, the 2-year, and the 10-year yields. You can get all that information right at bankrate.com. There's the website, and this is where we stand today. Bottom line is that the 10-year yield is yielding less than the 91-day yield and the 2-year yield. What that means is that the yield curve is an inverted, and you have an inverted yield curve. That's why it is red. And yes, under normal conditions, you do not have an inverted yield curve. The 10-year should be a higher interest rate than the short-term rates, because then that is telling you that the way that the bond market looks at the economy, it looks at the economy is at a growing and strengthening rate. When your longer term perspective is less than the shorter term perspective, that means that the bond market is telling you that there is not good economic activity happening over in the future, over the next 12 to 24 months. And then you have an inverted yield curve. That is not good for the stock market. Another thing that is not good for the stock market is rising interest rates. So we look at our 10-year yield, this column, we compare it to 1 year ago, this column, and you can see that we have dramatically increased from 1 year ago 10-year yield of 1.48 to the current yield of 3.69 under the 10-year Treasury rates. Well, that's a rising interest rate. That's why it is in red. And this information is telling you to get out of the market. So from a bond perspective, the bond market is telling you to exit the stock market and to sit on the sidelines. That's what this information is telling you. Now, we look at another indication of what the stock market is doing. This is a seasonality chart of the S&P 500 going back 20 years. And we are in the month of December. In the month of December, going back 20 years, there is a 70% probability that the S&P 500 will close higher at the end of December than when it entered December. It tells you right here the percentage of months in which the S&P 500 closed higher than it opened from 2003 to 2022. So that's telling you there's a 70% probability that it's going to be a plus month for December. This is a monthly chart of the S&P 500. Each one of these candlesticks represents the 1 month of data or the current month. This month isn't closed yet because we're still in the month of December. But the bottom of this candle is where we are currently at. And what this chart is telling you is that there is a 70% probability that from this level, it's going to close and go above this level here, about 5.64% from where we are currently at to where it needs to go. And that's what this chart is telling you. So the odds in this information is telling you that, and there's only, by the way, I don't think that that's going to happen. This is going to be a negative year for December for the S&P 500. The only thing that we don't know is how negative. Is it going to be more negative than it is now, or come up a little bit and close in here and just be down about 3%, which could very well happen. Now, this chart here is a monthly chart going back 20 years for the S&P 500. And this the red and black solid line that you see here, that's the S&P 500 going back 20 years. And just so that we're all on the same page, the way that we want to make our money, we want to make our money from here to here. This is the easy money that we want to make. Where are we at? Well, in 2022, if you look at 2022 and you go up, you can see how we've crossed down below all of these exponential moving averages, the 10, the 12, 14, and so forth. Many, many moving averages here, just to kind of see how things are playing out. We've crossed below all of them. Then we've bottomed and come up, and then come down and come up. This is basically chaos. Chaos for a trader. Unlike in 2009 when we had the mortgage meltdown, you can see that the S&P 500 crossed below all of the exponential moving averages that we have on the chart, and it tried to come up once, stayed below it until it bottomed and then came back up. This would have been a much easier way to trade after we got rejected at these moving averages and then came down. Then we could have made some money on the way coming down here. But in this type of an environment, as a trader, trying to trade that is very, very difficult, okay? Not exactly easy waters to tread in, because the market is confused. The market doesn't know what it wants to do. It's not clean. There's a lot of chaos in here. Now this information, this is the MACD and this is slow stochastics. The MACD is telling you that here it's got more room to fall, but the histogram, you can see that it started to come up. That's bullish, that we've reached some sort of a bottom. The slow stochastics here has already bounced off of the 20 and went positive above the signal line. This portion of the chart, the actual price chart, is telling you that we've hit a resistance line here and we are headed back down. So again, cross currents, chaos, very, very difficult to try to trade this as a trader. You know, you have one indicator telling you the market's going to come up. You have another indicator telling you that the market's going to come down. So it's a very, very difficult trader's market right now. Waiting patiently for the easy money is more prudent of a strategy to do. Trying to make plays in the short term, though, if we feel that the odds are in our favor. But in this type of an environment, you have to pretty much be what's called a nimble trader. You can go in, you can make some money, you can put some money into the market, but if it's not going in your direction, you got to be nimble to get out. Now so when you look at this is a long-term time horizon, monthly charts. Now we're going to go to an intermediate term time horizon. Each one of these candlesticks here is 1 week's worth of data. It tells you that we are on the weekly chart right now. So you can see that on an intermediate time frame, we're in this downward megaphone pattern pretty much is the price channel that we are trading, that the action has been in. We've hit this upper resistance line here for the third time. There's one, there's two, this is the third time recently, and it is beginning to come down. So this is telling you that we are going to come down to possibly this lower channel. The slow stochastics and the MACD both have topped and are curling down. The slow stochastics are already below its signal line. So on an intermediate time frame, the chart is telling you that we are going to come down, although the last week's worth of trading was that spinning top. Spinning tops indicate changes of direction. So, and then going back to that seasonality, month of December. So it's very possible that we're going to come back up, kiss that resistance line, and then come back down. It's very, again, very difficult in order to figure out exactly what the market is wanting to do here. Now this is going on to the daily time frame. So this is a short term. We went from the long term to the intermediate term, now to the short term, daily time frame. The chart is telling you that in the last week, you've been in this kind of a tight trading range. The market has come down here, and it possibly has reached a support level of about 375. We know that 390 is a resistance level. Below 390 is bearish, above 390 is more bullish. But you have a 200-day moving average and you have a 30-day moving average. The 30 is below the 200 is coming down, and the price is below both. All of these things are negative for the market. Now, looking at the MACD is below the signal line, but if you look at the histogram is showing you that it wants to reach a bottom and turn. So there is a change of momentum here in the histogram. Slow stochastics is already above its signal line and has broken above 20. That is telling you that it wants to come up to 80. That means that this is going to come up. This information is leading me to believe that from the S&P 500's current level of SPY ETF, the current level of 382.91, is over the next week or so is going to come up to this 390 level. So on a short-term time basis, the market looks more bullish than bearish. Let's look at the VIX. The VIX, which is the volatility index, which also is called the fear index. Basically, you want to buy when the you want to buy the S&P 500 when the VIX is here, and you want to sell the S&P 500 when the VIX is here, because when the VIX is high and it is coming down, the S&P 500 works inversely to this. When this comes down, the S&P 500 goes up, and when this goes up, the S&P 500 is coming down. So over the last week, we've kind of been in this up and down thing. It's not exactly clean. The MACD is right above the signal line, wants to cross, but it hasn't crossed yet. If indeed next week the S&P 500 begins to go up because of that spinning top and the other information, that's going to take this VIX and that's going to drop it down. And that means that MACD is going to go below its signal line here. It's going to cross below here and possibly come all the way down to this lower trend line here, meaning that for the next week or so, we're going to see the S&P 500 is going to be advancing. And with the S&P 500 advancing, the VIX is going to come down. And who knows how far low it's going to go, but it's going to come down lower than its current level of 20.87. Now we're looking at the Think or Swim platform. This is a one-year chart of the S&P 500, and the gold lines are -2 and +2 standard deviation. The pink lines are -1 and +1 standard deviation. The black line is the 200-day moving average, and the green line is the 50-day moving average. Now, currently, the 50 is below the 200, and we're trading below both the 50 and the 200. We're almost at the medium point of the regression channel of the standard deviations on the one-year chart. There was a measured move right here, and I'm going to show you on the next chart what that looks like on the 3-month chart. I'm going to blow this up so that you can see it. On the MACD, this chart is telling you that there's softening happen, and on the slow stochastics, we've bottomed and we've come up. Again, plenty of cross currents all over the place with this this whole chart. Now we're looking at the same thing, the S&P 500. Each one of these represents one day, but instead of going back a year, we're going back only 3 months. There's only 3 months worth of data on this chart. This is that measured move I was telling you about. So that's where you had a high, a low, a lower high, and then it crossed below this low here on this candle right here, telling you that you have confirmation that the market is going to move in this direction to a Fibonacci extension. Now, I've put in the 127 and the 161, but the problem is that on the 3-month time frame, even the 127 Fibonacci extension is way outside of the -2 standard deviation. You got to understand that 95% of your trading will happen between the +2 and -2 standard deviations. So there's a 95% probability that this 127 Fibonacci extension from this measured move will not be met, at least not met in the short term. It may be met down the line, but I would say over the next 30 days, there's a 5% probability that we're going to meet this. So according to this, there's a higher probability that we are going to now bounce and go up. So for the remainder of this month, which is, by the way, only 1 week's worth of trading, for the remainder of this month, I'm thinking that the S&P 500 has more opportunity to be bullish than bearish. And with that said, the -2 standard deviation is at 372. So there's one play here that we could make that I'm seriously contemplating to make, and that is a cash secured put trade. Let me show you what that would look like. So this is the Thinkorswim platform. This is for the SPY, and this is under the the expiration date rather of December 30th, 2022. So it's the end of the year. So Friday, the end of the year. That expiration date, and with the strike price of 375, which has a delta of 0.19, meaning that there is an 80% probability that, according to the Chicago Board of Option Exchange, that this strike price of 375 will not be met. Currently, the trading price is 382.91 for SPY. So the probability of it meeting or going lower than 375 is only a 20% probability, but still a 20% probability that it could still hit it. But would you mind owning the S&P 500 at $375 a share if you purchased it by now and the end of the year? It's not a bad purchase. So I don't mind putting some money at risk here. So what I did was I put in one contract, which is sell one contract. So we're selling a cash secured put. We're selling one contract of the S&P 500s by 100 shares, which is one contract, and the expiration date is December 30th, 2022 with the 375 strike price. It's a put option, and the amount of money that we are going to receive for that is 99 cents per option times 100 options is $99 is the maximum profit you're going to make. Now, the way that my broker does it is that they say, okay, the credit that you're going to receive is $99. It's going to cost you in commissions, trading commissions, 65 cents plus 1 cent or 66 cents to do the one contract cash secured put, and the amount of credit you will actually receive is $98.34. Still close enough to $99 that we don't really need to worry about it. Okay, so now that we have all this information, I want to put that into my cash secured put calculator. And I have here on Excel a cash secured put calculator, and I pretty much input all the data that we already know. We know the symbol is SPY, we know it's large cap, we know that it's $382.91 per share, and the option premium is 99 cents per share. The put strike price for that option is 375, and we're going to do one contract at 100. And we could change that to different number of shares, but for purposes of right now, we'll just put it in at 100. The proposed or real purchase date. Now, this date has to be a trading date when the trading floor is open. Today is Saturday that I'm creating this video. The market is closed. I cannot put this trade in, so this is not accurate information for the information that I have on a Saturday. I have to wait for the trading day, see what the actual live information is, input that in order to get the real thing. So I'm showing you what the process is that I'll make the determination when trading actually opens and to see if I actually want to place this trade. But this trade does look appetizing to me that I would want to take this transaction. This is 2022 and today is 12/20. Right now, the day that I'm creating the video is 12/24/22, the day before Christmas. Well, the market is closed. The NYSE is observing Monday, December 26th as the Christmas holiday observed. So the market doesn't open until Tuesday, 12/27/22. So the proposed or real option purchase date, the earliest date that we can purchase this option is on Tuesday, 12/27/22. The expiration date is 12/30/22. We know that. So it's only a 3-day trade, very, very small trade. The time value is 99 cents per share, and the cash required in order to put up 100 shares is going to be $37,401 based off of this strike price and how much money you get based off of the $99. That's why instead of being $37,500, it's $37,401 because it's a 375 strike. Okay, so there's your break-even cost. So the market would have to go all the way down from its current price of 382 down to 374 for you to start to actually lose money. So it's a fairly safe bet that you can take with this transaction. So you could step this up and do 200 shares instead of risking 37,000. You'd have to double that. So it would be what, $72,000. So still way under what we have in our current cash portfolio because we're just sitting in cash. So all we're trying to do is just get a little bit better return on investment for 3 days. That's all this is. But we are putting money at risk if we were to move forward with this transaction. But it is not a bad transaction to make. The return on the option, if the option is flat, is going to be 0.26%. The premium that you're going to receive is $99 for this 100 shares. And if the market happens to fall below the strike price of 375, we're going to purchase at 375, then we're going to get it we're going to purchase these 100 shares at a 2.32% discount from its current trading price of 382.91. The profit on the trade, not including commissions, is $99. Profit or loss on the trade would be 0.26%. Now, if we annualize that, mind you, this is only a 3-day trade. Annualized, if we go out and convert all this information on an annualized basis, that would be an annual return on investment of 32.21%. And let me tell you, if I was to receive a 32% annual return on investment in my portfolio, I would be a very happy camper. That is a fantastic return on investment. We're not risking our entire portfolio. We'd only be risking $37,000, or if we even doubled it, we'd be risking $72,000. And again, you're not making a lot of money, $100 or $200, but it's a very short-term trade, and I am strongly considering doing this trade on Tuesday, 12/27/22. But I won't make that decision until the day actually opens and I see where we're at. If the market, if all hell breaks loose in the world and some black swan event were to hit the stock market and the stock market were to open 10% to the downside on Tuesday, 12/27, obviously I'm not going to be placing this trade. I'm not going to place this transaction with that information. I'm only going to be placing it if the market seems to be in a somewhat of a steady state. If the market is jumping up dramatically, I still may place a cash secured put trade, but instead of doing a 375 strike, maybe what I'll do, let's see here, 375 would be right about here, right where that low tip is right there. Maybe I'll do at this point right here, about 378 or something like that. I can totally adjust what my strike price is. I have not made the trade yet. I don't even know if I'm going to make the trade. I'm going to wait to see what everything looks like on Tuesday, the 27th. And if everything seems okay and the market is not moving that much, we're still in this somewhat of a trading pattern, not really coming out of it, not really going above it, then at that point in time, for the 3-day trade, I would go ahead and place the trade just to make some profit, and that's it. So basically, that is going to conclude this video. I hope you enjoyed the video. Please, if you haven't done so already, please click on subscribe to subscribe to my channel so you can see all the videos that I post. Ring that bell so you'll be notified when I do place a video. And do me a solid right now and click on that like button if this content is right up your alley. And with that, I am going to wish you good trading.